Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are providing an audio summary for Candel Therapeutics.
And if you find our talks useful, please consider subscribe, like, and comment underneath. So, I was actually looking at the charts right before we hit record, and, well, honestly, it looked a bit like a crime scene.
Yeah, there's a lot of red on that screen right now.
A drop of over 14% in just one single week. That is a lot of red. So, the big question on my mind, and probably for everyone listening who holds this, is pretty simple. Is this a disaster in the making, or is the market, completely misinterpreting a major move here?
It's the classic biotech question, isn't it? Panic or opportunity. And with Candel, I think the market is reacting to the mechanics of what just happened, specifically the dilution, rather than the fundamental shift in the company's future.
Right.
Because if you look past that big red candle on the chart, the story has actually gotten significantly stronger in the last few days.
Stronger. That is a bold claim when the price is dropping like a stone. But before we get to the money and the drama, and there's definitely plenty of both, let's unpack who Candel Therapeutics actually is. I know they're in the biotech space, but that covers everything from, making Band-Aids to cloning sheep. Where exactly do they fit into the ecosystem?
They are a clinical stage biopharmaceutical company. And that first part, the clinical stage, that's the key distinction here. It means they are entirely pre-commercial.
So no actual products.
Right. They do not have a drug on the pharmacy shelf that you can go buy today.
So no product on the shelves means essentially no cash register ringing yet. We are strictly in the hope and dream phase.
Exactly. They are purely in the research and development phase right now. But the technology they are developing is, well, it's truly fascinating. They use something called the Enlighten Discovery Platform.
Enlighten? Sounds like a high-end yoga studio, but I assume it's a bit more high-tech than that.
Much more high-tech. It's a proprietary platform for developing viral immunotherapy.
Viral immunotherapy. Okay, so instead of blasting the body with radiation or, harsh chemicals, we're actually using viruses to fight the disease.
Precisely. So unlike standard checkpoint inhibitors, which simply take the brakes off the immune system and kind of just hope it finds the cancer, Candel is using advanced analytics to engineer viruses that can be injected directly into a tumor.
Wow.
Yeah, and this causes what they call multimodal immune activation.
Multimodal immune activation. That is quite a mouthful. Let's break that down for the non-PhDs listening right now.
Sure. Think of it as attacking the cancer from multiple angles all at once. It's essentially a two-front war. First, the virus kills some of the cancer cells directly. And when those cells die, they release antigens.
Which are like targets.
Basically little flags, yeah. They scream to the immune system, hey, the enemy is right here.
So it lights up the target for the body.
Right. But simultaneously, the therapy modifies the microenvironment around the tumor. Often, tumors build these defensive walls or bunkers that immune cells simply can't penetrate.
Oh, I see.
Candel's tech actually breaks down those walls so the immune system can actually get inside and fight.
So it's like dropping a flare on the target and blowing up the bunker doors at the exact same time. That is a very crucial distinction from just, boosting your immunity.
That's a great analogy. And their lead candidate doing this is called CN-24/9. They're currently testing it for prostate cancer, pancreatic cancer, and non-small cell lung cancer.
Those are major.
They are. And they have another one, CN-3110, which is targeting high-grade glioma, which is a very aggressive type of brain tumor.
Prostate, lung, pancreatic, these aren't just niche rare diseases. These are the big killers we're talking about.
They are, and that is exactly where the moat comes in. Their moat is built on extremely high intellectual property barriers. This isn't just mixing standard chemicals in a beaker. This is complex gene therapy. They are doing something highly novel with how they engineer these specific viruses.
Right, so you can't just reverse engineer it in a weekend.
Exactly. It's very hard for a competitor to just copy-paste this approach because of the sheer complexity of the Enlighten platform.
It sounds incredibly futuristic. High risk, high reward, right? That is basically the biotech mantra. But listening to this, I'm getting really excited about the science, yet I cannot help but think about the business side of things.
Naturally.
You mentioned they are pre-commercial. That usually translates to we spend a whole lot of money and we make absolute zero. Are they actually selling anything yet?
You hit the nail on the head there.
Yeah.
If you look at the financials, it is ugly. There is absolutely no recent revenue. In fact, their revenue growth rate over the last 3 and 5 years is negative 100%.
Negative 100%. Well, that is thorough.
It is absolute. And
Yeah.
the margins are exactly what you'd expect from a lab that only spends money. We are talking about pre-tax profit margins of negative 58,000%.
Okay, I have to laugh at that number. Negative 58,000%. That is barely a real number at that point. It's like dividing by zero on a calculator.
It's just the nature of the beast in this sector. They have massive R&D expenses. They're running massive clinical trials, paying top-tier scientists, keeping the lights on in the labs, but nothing is coming in the front door. Their earnings per share is negative 54 cents.
And the cash burn.
Burning very bright. Free cash flow is negative $21 million. Basically, money is just flying out the door every single quarter.
Okay, so let me get this straight for everyone listening. No money coming in, tons of money going out, margins that honestly look like a typo on a spreadsheet. Why hasn't this company completely collapsed? Why are we even talking about them today as a smart wealth investment?
Because in biotech, you do not look at today's price-to-earnings ratio. You look at runway. You look at the balance sheet's ability to sustain the company until the science actually works and gets approved. And this is where Candel gets really interesting.
Okay.
Despite those terrifying income statement numbers, their balance sheet is actually a fortress.
A fortress. With negative 21 million in cash flow. How does that even work?
Look at their liquidity. The current ratio is huge. It's sitting at 8.3.
Wow.
Yeah, that means for every single dollar of debt or short-term liability they have over $8 in liquid assets to cover it.
That is incredibly high. Usually you see companies really struggle to keep that above a 1.5 or a 2.
Exactly. And their debt load is tiny. Total debt to equity is 0.09. They basically have zero debt.
So to use an analogy here, they are essentially burning the furniture to keep the house warm, but they happen to own a massive warehouse full of furniture.
That is the perfect way to put it. And they actually just bought a whole lot more furniture. This is really the pivot point for what we're discussing today. The reason the stock dropped recently wasn't because the science failed in a trial. It was because they reloaded the warehouse.
Ah, okay. So this brings us to the news that triggered that 14% drop. The catalyst. What exactly happened on February 19th and 20th?
It was a one-two punch of financing. First, the market event that really scared retail investors, a public offering. On February 20th, they priced an offering of about 18.3 million shares at $5.45 per share.
Right.
That raised roughly $100 million.
And the market always hates that because of dilution. I mean, if you're listening and you owned a piece of the pie on Monday, your slice literally just got smaller on Tuesday because the company baked a bunch more slices.
Correct. The stock fell from a high of 585 down to around 509 because existing shareholders saw their ownership percentage actively shrink. It's a total knee-jerk reaction from the market. Dilution means sell.
But you said it was a 1-2 punch. Usually dilution is just a straight jab to the face that knocks you down. What was the second part of this?
This is the part that I think the retail market is completely underappreciating right now. The day before the stock offering, on February 19th, they announced a $100 million royalty funding agreement with RTW Investments.
Royalty funding. How exactly is that different from just selling more stock?
It's mostly non-dilutive. RTW Investments is giving Candel cold, hard cash right now in exchange for a percentage of the future sales of their drugs.
Wait, that is actually a huge signal, isn't it? I mean, selling stock is relatively easy. You just find gamblers or funds willing to take a risk. But selling royalties means the buyer fundamentally believes there will actually be sales to collect on.
It is a massive signal. Think about it. RTW Investments is a smart money firm. They specialize heavily in life sciences. They aren't just gambling on a meme stock.
Right.
They did deep due diligence. They likely had teams of medical doctors and PhDs look at the raw data for CN2409 and said, we are willing to bet $100 million that this drug will be approved and will sell enough for us to make our money back, plus a profit, on royalties alone.
That is a serious vote of confidence. If a company sells stock to the public, they're just raising cash. If they sell future royalties to a specialized investment firm, they're basically getting a medical co-signer on their future success.
Exactly. Yeah. Candel just brought in $200 million total in a matter of days. $100 million from the public markets and $100 million from the industry experts.
And what are they actually doing with this new $200 million war chest? Is this just for padding executive bonuses?
No. They are going straight for the kill here. The funds are specifically earmarked for the commercialization of CN2409 for prostate cancer.
So getting ready to actually sell it?
Yes, building the supply chain, prepping the sales force, all of that. And the rest is to fund the phase 3 trials for non-small cell lung cancer.
So this isn't just money to keep the lights on in the lab for another year. This is actual growth fuel.
It is the bridge to the finish line. Before this funding event, you could easily argue they might run out of cash before the phase 3 trials even finished. That is always the biggest risk in small-cap biotech. Now, they have the complete runway they need.
That really changes the perspective on the stock drop entirely. The price went down because of the math mechanics of the share offering, but the actual fundamental value of the company, its ability to survive and launch a drug, just went way up.
Precisely. And that brings us perfectly to the technicals. What is the chart actually telling us right now while the market digests all this new information?
Well, looking at the recent price action, we are definitely in a downtrend or at least a tight consolidation phase. The stock retreated from that 563 level all the way down to around 509.
Right. And there is a very clear battleground emerging on the chart. The support level seems to be firmly around $5.20. The stock really doesn't want to go much lower than that. But the resistance level is practically painted in neon lights right now. It's at 545.
545. Now, that was the exact offering price for the new shares, right?
Right. Yes. It is a psychologically critical level. The institutions that bought in at the offering paid 545. They're going to defend that level fiercely, but it also acts as a heavy ceiling until the broader market digests all those newly minted shares. It's just a lot of supply to chew through.
It's almost like the stock is suffering from a bit of indigestion. It ate way too much supply way too quickly.
And looking at the volume, there really isn't strong buying support just yet. The market is waiting. It's very much in a show-me mode. But here is where it gets fascinating. We've talked about what the market is doing today. Let's talk about what the analysts think it should be doing tomorrow.
I always love this part. The Wall Street crystal ball gazing. What is the actual consensus right now?
It's a strong buy. We currently have 7 buys and only 1 hold. But the price targets, you really need to look at the spread here.
I am looking at these numbers right now. Are you sure these aren't typos?
No typos. The average price targets are sitting comfortably between $18.33 and $18.63. And the high target is $25.
Wait, let me just do the mental math here for everyone. The stock is currently trading around $5. If it goes to 18, that is not a 20% gain. That's what?
That implies an upside of 226% to 299% from current levels.
Wow. That is massive asymmetry. You basically risk the stock going down maybe at $1 or $2 if that support level fully breaks versus a potential triple-digit percentage gain if the thesis plays out.
That is the textbook definition of a smart wealth play. When it hits incredibly hard. The analysts are looking at the probability of FDA approval for CN-2409, and they are basically saying, if this works, this company is fundamentally worth 4 or 5 times what it's trading at today.
But the word if is doing a whole lot of heavy lifting in that sentence. We have to be responsible here. Let's look at the risks involved. What is the bear case? Why would a rational investor look at this setup and say, no thanks?
The bear case is very real, and you absolutely shouldn't ignore it. First, the dilution we talked about. There are 18.3 million brand new shares floating around. Right. That means earnings per share will be much harder to grow in the future because the denominator is just permanently bigger. Existing shareholders have been watered down forever.
A smaller slice of a bigger pie is still mathematically a smaller percentage.
Exactly. Second, and this is the really big one, clinical risk. Phase 3 trials are notoriously difficult. It's literally known in the industry as the valley of death for drug development.
Because the hurdles get higher.
Right. Drugs that look absolutely stellar in phase 2 can completely fail in phase 3 because the sample size gets significantly bigger and the statistical hurdles for efficacy get much higher. If EN-2409 fails its lung cancer trial, or if the prostate cancer data just isn't compelling enough for FDA approval, that entire $200 million will just burn up and the stock will absolutely crash.
And with those deeply negative margins we talked about and no other source of revenue, if the flagship drug fails, they immediately revert to being just a cash-burning machine with no actual product to sell.
Correct. Plus, right now, their return on equity is negative 101%. As a day-to-day business operation, it is wildly inefficient. You are betting solely on the future science panning out, not the current business metrics.
It's a binary outcome. It works and you win big, or it fails and you lose big.
Pretty much. But let's look at the bull case now. The overarching thesis for why this might actually be a very smart move. I would personally give this setup a bullish score of 7 out of 10.
7 out of 10, that is pretty confident for what is essentially a scientific coin flip. Walk me through the bull thesis.
The core thesis is that the recent $200 million liquidity event completely bridges the gap to actual revenue. The single biggest risk for any small-cap biotech is running out of money before the science has a chance to prove itself.
Right.
Candel just solved that massive problem. They finally have the cash on hand to get all the way to the finish line.
So the immediate bankruptcy risk is essentially off the table for the near future.
For the next 12 months, largely yes, they have the financial runway. Also, you have to consider the broader macro environment. We are all expecting rate cuts eventually. When interest rates go down, high-risk, cash-rich clinical plays like biotech companies tend to significantly outperform the broader market.
Right, because money just becomes cheaper and institutional investors stop hiding in safe haven assets and start getting willing to take on much more risk for that explosive growth.
Exactly. So you have a company with a massive cash pile right now, a highly respected smart money partner in RTW investments, and a potential best-in-class drug for both prostate and lung cancer.
So what is the actual time horizon here? This isn't a quick day trade, clearly.
No, definitely not. This is a multi-year hold. I would say 6 to 12 months at a bare minimum. You are waiting for the phase 3 catalysts to hit. You are waiting for the final data readouts and the commercial launch updates. You have to be patient enough to let the actual science play out in the labs.
So, if you are the type of investor who checks their portfolio app every 10 minutes to see if you're rich yet, this one might definitely not be for you.
No. This is firmly in the put it in the drawer and wait for the news alerts territory.
Let's summarize this for everyone listening who is trying to make sense of all these moving parts. We have a pre-revenue biotech company, Candel Therapeutics. They are burning cash like a bonfire, but they literally just backed up a truckload of money, $200 million to be exact, to ensure they can fully finish their clinical trials for a very promising prostate cancer drug. The stock dipped hard on the news because they had to print new shares to get half that cash, but the Wall Street experts actually think the stock is undervalued by potentially 200 to 300% right now.
That is the perfect snapshot. It is a classic asymmetry play. The retail market sees immediate dilution and panics. The smart money sees a fully funded, de-risked path to commercialization.
It really is a fascinating setup to watch unfold. It feels like one of those rare moments where you can see the two divergent paths incredibly clearly. Path A, the trials fail, and it's a complete bust. Path B, the trials succeed, and that $5 share price is going to look like the absolute bargain of the century in hindsight.
And remember, the royalty deal is the massive tell here. RTW Investments would not tie up $100 million of their own capital if they thought Path A was the likely outcome. They have entire teams of PhDs analyzing this data before they write a check.
That is such a great point. It's almost like getting to peek at the smartest kid in class's homework before the test.
Exactly. But, as always, you have to do your own due diligence. Biotech is inherently volatile. Do not bet the mortgage on a clinical trial.
Very wise words. Okay, here's a final thought to leave you with today. We talked heavily about that $100 million royalty deal from RTW Investments. We mentioned they are the smart money. But let's really think about what that actually means behind closed doors. These specialized firms don't just look at public data on Yahoo Finance like the rest of us. They almost always get access to confidential data rooms, deep dive interviews with the executive management, and expert medical consultations that the retail public never ever sees. So if they're willing to bet $100 million on future royalties, meaning they literally only get paid if the drug gets approved and sells, you have to wonder, do they know something about the interim trial data that the retail market is completely missing right now? Are we seeing a public confidence vote that is actually a sneak peek at the final results?
That is the multi-million-dollar question. If their confidence is entirely based on interim data we haven't even seen yet, the current share price might be totally disconnected from reality.
Definitely something to mull over as you watch that chart this week. Thanks for tuning in to this audio summary on Smart Wealth with Joshua. We will be right back here tomorrow.
Thanks for listening, everyone.
See you next time.